So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from OptionAlpha.com, and welcome back to The Daily Call. Today we're answering the question, can you sell options without owning at least 100 shares of stock? So this is actually a really interesting one and a very common misconception that people just don't understand as they get started into options trading. Now, it's not their fault that they don't understand it. I don't think anybody really explains it. That's why I'm trying to do this podcast about it, so that people understand what the risks are and what you actually need to do, or what capital you need to have if you actually want to start selling or buying option contracts. So a big common misconception is, well, I can't sell options if I don't have 100 shares of stock. And what I think the root origin of this misconception comes from is from when brokers initially approve people to start trading options. They usually approve people to trade covered calls and covered puts. And when you do a covered call or covered put, yes, you do need 100 shares of stock, either long stock or short stock, to be able to then sell that option contract. But that's where it kind of ends. After that, if you wanted to sell option contracts, you don't necessarily have to own 100 shares of the underlying stock. And in fact, 99% of the time when we're actually making trades, we do not own the underlying shares of stock. The only time we would ever own shares of stock is if we got assigned and then we wanted to sell a covered call and maintain the position. But for the vast majority of trading that we do, we never actually deal with the underlying stock. So I think the misconception is, well, if I don't own the shares of stock, then how can I sell options against it? And the way you can sell options against it is either one of two ways. And I guess they both actually work the same, but generally you can do it two different ways. One is you can put up what's called margin. Now, margin is not the margin that you're typically associated to learning about, and that's, borrowing on margin to buy stock. I'm talking about putting up margin in your account, which means that the broker basically takes a certain portion of capital associated with the risk of that trade and sets it aside so that you can't trade it. Now, it's your own money, but they're basically just saying, look, you can't trade this amount of money in your account because you have this short option contract. And if that option contract goes bad, we need to make sure that, you're not trading some other part of your account or some other capital that could then cover that risk in that position. So say you have a $10,000 account, you sell an option contract, the broker might take $1,000 of margin and put it aside. Now, again, they didn't take it out of your account. They're just saying, look, you can only trade with $9,000 now for any new positions that you enter, because the $1,000 that we took aside in margin is basically to cover that one option contract that you sold. Okay, so you don't actually need the shares of stock to do it. You can do it by putting up margin. Now, the other way you can do it is you can trade a spread. So you can sell one contract and buy another contract. And in that case, you just put up the difference between the contracts, less the credit that you receive, as again, the margin. So it's much less capital intensive. You're going to make potentially less money on the trade because you have to buy and sell contracts instead of just selling options without buying. But in that case, you also don't have to own the shares. You're basically covering the position by buying the other option contract. This is a great alternative if you don't have a margin account that you can trade in and you want to sell options, but you're in an IRA or retirement account. So IRA or retirement accounts don't allow you to sell naked option contracts at many brokers. And so if you want to do that, you have to go ahead and do a spread or a very wide spread to synthetically replicate a short option contract. But in either case, you don't have to own the underlying shares of stock. So the last question is probably then, well, what happens if I get assigned? Because I don't have the underlying shares of stock, what would happen? Well, there's two things that can happen. One, you either have enough cash in your account to then cover the shares, right? So if you get assigned stock, now the broker will assume that you had to buy or sell those underlying shares at whatever the market price is and whatever the strike price is. So if your account does have the amount of capital in there to cover that, well, then you can choose to hold the stock or not. So you can decide, hey, I don't want the stock, so I'll sell or buy it back in the market, or choose to hold on to it if you want to. If you don't have the capital to then cover the 100 shares of stock, then what the broker will force you to do is just to liquidate the stock position the same day. And so yes, that means that if you are assigned 100 shares of stock, then you can go ahead and sell back that stock because the broker knows that you're liquidating the position. You're not taking on risk for more than a day. So they're going to force you to do this. Now, you can do this yourself, or if you just don't have the time to do it or miss an opportunity to do it, the broker will do it for you. So they'll do it for you by the end of the day so that you basically don't carry risk overnight. So you don't have to have capital in there to deal with it. Again, the brokers know that you're basically removing risk or you don't have the capital to deal with it. So they'll allow you to sell or buy back the shares in the open market to close and liquidate the position. So as always, hopefully this helps out. I know this is a common misconception, a common point of confusion for many people. So hopefully this podcast cleared it up. If it did, let me know, share it with your friends and family. And as always, if you guys have any questions, please let us know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.